Good afternoon, everybody. My name is Anthony Kazazis, and I am the director of the NYC Real Estate Expo, as well as the NYC Network Group. And today we have Brittany Melville from Next Generation Trust Company. And her presentation, her webinar presentation, will be the future of real estate in IRAs. And at this point, I'm going to let Brittany now give a little bit of information about herself and her company and her role. And by the way, we will have Q&A. So please, if you have any questions and you want to put it into the Q&A section, please do so. Brittany?
Thank you so much, Anthony. Good afternoon, everyone, or morning, depending on where you are today. Hope everyone's enjoying the expo so far, and very much looking forward to hopefully getting together again next year with an in-person option at least. But for now, we'll make do. My name is Brittany Melville. I'm the Director of Marketing and Sales with Next Generation. Next Generation is a women-owned business based out of northern New Jersey, and the company is a self-directed IRA custodian. So for you real estate investors out there, whether you're looking to invest in real estate yourself or you have real estate investment opportunities that you would like to present to potential investors, or you're looking for capital, as you may know, the ability to hold real estate in IRAs is a powerful tool. So today we're going to talk a little bit conceptually about self-directed IRAs for those who may not be as familiar, or for those who may have had some level of exposure to talk about self-directed IRAs but may not be expert on the topic. And then I'm also going to provide an update on some of the rumblings around some pending legislation that's been through Congress, as that could have potential implications for not only real estate in IRAs, but IRAs that affect everyone. So with that, I did mention that the company is a custodian for self-directed IRAs, and essentially what that means is we're a financial institution that's similar to like a Fidelity or a Vanguard that might hold other retirement accounts. We provide very similar services, but our expertise is only in self-directed IRAs. So we don't hold public stock, bonds, or mutual funds, or any other public securities. We are specialized in holding privately held alternative assets in tax-advantaged vehicles. With that necessary disclaimer that although we are a financial services organization and we provide custody and administration for self-directed retirement accounts, we are not financial advisors. So we do not sell or endorse any specific investments. Rather, we are more like a neutral third party in the whole situation, in that we provide lots of education about the rules and guidelines surrounding using self-directed IRAs. And then with that, investors are expected to choose their own investments and do due diligence. So we do provide guidance from a procedural standpoint, and of course we do have obligations as a financial institution, but the information is primarily for educational purposes. So in terms of how to define a self-directed IRA, I sort of just did a little bit. So as I mentioned, it is a type of retirement account that allows you to invest in non-traditional assets. So when we think about traditional assets, we typically think that if you have an IRA or retirement account, that you have to invest in the stock market through that account. Surprisingly, that has not been true since 1974, when IRAs were basically introduced, but it hasn't been a widely known strategy until probably more recently that this is coming about and more popular. Some of the obvious benefits of being able to invest in things like real estate through a retirement account are the ability to earn tax-sheltered or tax-free investment returns. So you can do lots of similar types of investments that you might do outside of a retirement account, but while funneling them through a retirement account, be able to defer tax on your earnings or avoid some of those taxes altogether while using a long-term wealth building tool like a retirement account. Additionally, we talked about in a world of uncertainty, and a market of volatility, when we're putting our hard-earned dollars into these types of accounts, and we're really hoping that we'll be able to retire at a reasonable age and be able to rely on these streams of income in a way that we are not expected or having to work full time. How do we know for sure that we're going to get to a point where we can rely on the funds we have saved, and that we have saved enough that we need to survive alone on these dollars? Investing in alternative assets can be a way to diversify your portfolio beyond what most people talk about when they say we're diversified. Most of the time when advisors refer to a diversified portfolio, they're saying, okay, you have some equities, you have some bonds, you have a mix of different asset classes, but they're all still public. So looking beyond that to private alternatives, there are some differences there. Alternative assets tend to not be correlated with market performance. So if there's a lot of fluctuation in the market, alternatives tend to return more stable earnings over a longer period of time, which can bode well for a retirement account, which is a long-term investing tool, right? When you put your funds in there, the plan isn't to take them out in the short term. Most of the time, you're looking to keep them in there and invest and reinvest and grow that amount and hopefully accelerate the rate at which you're growing that. So self-directed IRAs can be yet another tool in your toolkit to consider doing that. And on top of that, having the ability to invest in these types of things puts a little bit more control in your hands versus buying stock in a large corporation where you're a minority shareholder and you may not have much control or much say about what goes on in that corporation, and its performance may not really be within your control at all. Whereas if you're investing in alternatives or you're finding a real estate deal, you have the ability to seek that deal and choose that particular deal that you believe is going to perform best for your financial planning purposes. And so you have a little bit more control over the return on investment that you're getting. And when you think about a successful real estate project and the types of returns you get on those deals, think about the percentage returns you typically get and compare that with what you're seeing in the stock market. You may be able to outpace growth versus if you were investing in the stock market alone. So as you can see, there are a number of different benefits to considering this as an option. Often, some of the just more like logistical, mechanical type questions that we get are what types of accounts can be self-directed? Or if I have a self-directed IRA, is it just one kind of IRA? And that's not the case. As you can see, there are many different types of IRAs you can open to be self-directed, and they work just the same as if you were using these types of IRAs to invest in the stock market from a tax implication perspective. So for example, if you had a traditional IRA with Fidelity, your funds go in pre-tax, everything that you earn stays in the account, it grows tax deferred, and then when you withdraw the funds at retirement age, you pay income tax on the withdrawals at that time. Same thing with a traditional self-directed IRA. If you invested in real estate, your funds would go in the account pre-tax. You can invest in real estate. Whatever that real estate project or deal returns goes back into the IRA. It grows tax deferred, and when you take it out, you would pay tax at that time. The Roth, which is a very powerful tool, Roth IRA, is kind of the flip side of that, where you're looking at after-tax dollars going into the account. They can be invested. The amount grows tax-free, and then your qualified withdrawals are also tax-free. And then if you are a real estate agent, or if you own your own business, if you get paid on 1099, you can potentially qualify for some of these other types of plans you see here, the SEP, the simple or qualified plans. Those are typically for business owners, and they have some additional advantages that might allow you to stow away more cash into them each year that you can then use to invest in some strategic projects. And then there are also two other types of accounts you see here that actually aren't even retirement accounts, but they have tax advantages and they can be strategically used to invest in alternative assets as well. the ESAs for children's education. Those funds can be withdrawn tax-free for qualified education expenses, and then the same thing with HSAs. For qualified medical expenses, those withdrawals would be tax-free. So in order to get funds into a self-directed account, there are a few different options. If you have existing retirement accounts with other institutions, you could potentially move some or all of those funds into a newly created self-directed IRA. If you have a old employer plan, like an old 401k that's kind of laying around, if you've either left corporate America or you've just left a corporate job and started a new one, you can take those funds and more actively manage them by rolling them into a self-directed IRA and putting them into some new deals. Or if you don't, or if you're currently working for your employer that has a 401k and they won't allow you to move those funds while you're working for them, but you have other IRAs, you can transfer funds from existing IRAs that maybe are not self-directed IRAs, and you like to take some of those funds and put them into a self-directed account. You can do that as well. And then if you often, for business owners, if you really don't have either of those options, but you do own your own business and you're making good money, you can take some of the money that you're earning out of pocket and deposit into a retirement account to start growing, to start getting some sort of baseline value to work with, and hopefully strategically invest that and grow that over time. So today we're going to talk about 3 different strategies that you can utilize, or 3 perspectives, I should say, if you're investing in real estate with an IRA. But I also wanted to mention as a quick aside that there are lots of things you can do. And you can see here everything from real estate, notes, tax liens, partnerships, joint ventures, hedge funds, private stock in pre-IPO companies, international investments, cryptocurrency, social investing. So there are so many different options here. And as you can see, some of these things could overlap that may fall in real estate category or may fall in just another, private startup company category. But within the realm of real estate, which we tend to see is the most popular asset class for self-directed IRAs, there are lots of things you can do, from purchasing raw land and developing on that land, purchasing a property to buy and hold or fix and flip. It could be a single family home. It could be a multifamily. It could be residential or commercial. You can get involved in crowdfunding and syndications. You can just form a partnership with a few investors and go in on a deal where there could be one IRA as a partner and just others involved, or a bunch of different people's IRAs in a partnership investing. So you can get pretty creative there. And then, of course, there's also the lending side of things. So you can, if you wanted to be more passive, you could use a self-directed IRA as sort of a private lender. And depending on who is borrowing and the relationship to you, you may be able to use that account to lend funds for maybe gap funding for a project, or just other types of funding that may be needed for a deal, or it can even be for unrelated purposes, not related to real estate. You can see the only 2 exceptions that the IRS has here are that you can't invest in life insurance and you can't invest in collectibles or antiques through an IRA. But almost anything else that's not publicly traded, you can start to get creative and let the gears turn and start thinking of different ideas. There are lots of different options. So the first strategy or perspective that I want to share with you is for the person who may be thinking, I'm not interested in having a self-directed IRA for myself, but hey, this has got me thinking that there are probably a lot of self-directed IRAs out there with lots and lots of money in them. And if I'm looking for money, whether I need funding or I'm looking for capital for, to raise capital for certain projects or for a business that I own, this could be a resource. This could be a channel to consider. So you can see here that it can be in the form of lending through notes or direct investment in a company or a fund that you might have. The only only type of entity structure that IRAs cannot invest in are S corporations. So if you have an LLC or C corp structure, that would be fair game for an IRA to invest in the entity. And of course, the benefit to the person investing with their IRA is if they're lending to you, you're going to pay them back likely in principal and interest, or maybe some equity participation in line with whatever loan terms you agree on, and that's going to go back to them tax sheltered. If they're investing from an equity perspective, they may be getting dividends or share of profits in return, and that would be paid back to their IRA and be tax sheltered. So this is really important to understand for anyone who is looking for investors and looking to build their network, and even tap into maybe their existing network, because this may be a question to ask those investors who are perhaps hesitant to use their personal funds. Maybe they don't want to pull that much money out of their savings account to invest, but maybe they have a lot tied up in their retirement accounts that they'd be willing to use. So it's important to understand this, to be thinking about that in the back of your mind when having these types of conversations, and to ask potential investors, hey, do you have retirement accounts that you would be willing to use rather than personal funds? Another perspective is if you're thinking that a self-directed IRA might be a strategy for you personally, as I mentioned earlier, you can use the account as a private lender, and these can be mortgage notes or just general promissory notes. This tends to bode well for self-directed IRAs because these are typically passive investments, and they're unlimited. So you can do as many investments or loans out of one IRA as you'd like to do. You also have the flexibility to decide if you want to loan to an individual person or an entity. So it could be a business or it could just be a person. And then, of course, as we mentioned before, the investment return is going to be paid back into the IRA. And then the other perspective here that gets a little bit more interesting and is very popular is to use a self-directed IRA to directly own property. So there are many ways to think about doing this. Property can be purchased in cash if there's enough money in the IRA to do that, but also keeping in mind that if an IRA is purchasing a property in cash and is going to own 100% of that property, the IRA itself would then also be responsible for all maintenance and expenses associated with it. So that's something to think about in terms of making sure there's enough cash buffer in the account to be able to handle expenses that may come up. And of course, anything that it's earning on investment will funnel back in, so that cash reserve, ideally over time, will be building up as well. If financing is needed, there is a loan option for IRAs, but it does have to be non-recourse, which has some additional limitations and additional requirements to consider. And I won't get into that in too much detail here because we're keeping it relatively high level. But another option, if you don't want to go the non-recourse loan route, if you don't have enough cash on your own, is to partner. So you can team up with another investor who has an IRA. You can even partner with yourself on a deal, and that's something I'll talk about more in a bit. Excuse me. Of course, if you're planning to flip the property, then when you sell it through your IRA, all the proceeds from sale go back into your account. No capital gains tax. And if you're buying and holding, then you'll continue to have that rental income funneling into the account. So we talked about partnering as an alternative, which kind of leads me into the not so pretty part about self-directed IRAs. And of course, anywhere the IRS is involved, there are going to be some rules. And they do have rules. So when it comes to educating yourself about how to use IRAs for real estate, understanding prohibited transactions is very important. So the IRS defines that as a transaction between a retirement account and a disqualified person. So I'm sorry, for some reason I'm choking right now, but I'm gonna flip to the next page so you can see what they define as disqualified persons. The first disqualified person, and if you think about this in terms of relationship to the IRA, would be the IRA holder. So if I had a self-directed IRA, I myself, Brittany Melville, am a disqualified person for my IRA, which means that I can't do a direct transaction with my own retirement account. As I mentioned before, I can partner. So let's say I wanted to go in on a property and my IRA had half the funds needed, then my IRA can go in as a 50% partner and I, Brittany Melville, could go in as a 50% partner. And if we kept those ownership percentages separate and distinct for reporting purposes and made sure that those ownership percentages were consistent throughout the deal and did not change, so that I were responsible for 50% of the expenses and then 50% of the earnings, and then my IRA also responsible for 50% of expenses, and then it would get 50% back in earnings, where it would not be taxed, but I would be personally. That can be done. So it's important to understand that, and it doesn't have to be a 50-50 split. It can be any ownership allocation split, and it doesn't have to be just two partners. It could be 3, 4, 5. But as you can imagine, as you add partners, it gets a little bit more complex. So it's important to understand that as well. Other disqualified persons, as you can see here, would include a spouse, ascendants, descendants, and their spouses, which if you think about your family tree in an up and down kind of linear fashion, those relationships like parents, grandparents, children, grandchildren also can't do direct transactions with your self-directed IRA. And then when it comes to other types of relationships, anyone that's providing a service to the IRA, like a custodian, for example, an accountant, an attorney, a financial advisor, any of those persons would not be permitted to do direct transactions as well. That could be a conflict of interest for them. But if the investment transaction is not taking place with a disqualified person, then you are free to commingle funds as needed, or sell and buy and lend and kind of do whatever it is that you'd like to do. And it's not to say that you can't do that with disqualified persons, but there are a lot more limitations and restrictions and rules and guidelines to be aware of. So that's sort of where a self-directed IRA expert would come in to provide that kind of guidance, to provide the education like we're doing today. But of course, today's session is just tip of the iceberg when it comes to having these discussions. And of course, when you're thinking about taking a considerable portion of your hard-earned funds and putting them into something, you want to feel comfortable that you know what to expect and that you're going through all the proper channels. So we talked about the different types of disqualified persons. So there are 3 different types of prohibited transactions as well. The first one is essentially what we described as a direct exchange and a transaction between an IRA and a disqualified person. The other one is lending. So lending to or from a disqualified person is not permitted, and any extension of credit. So no guaranteeing, like personally guaranteeing a loan that an IRA might take is not permitted. And then the third type of prohibited transaction is what we call self-dealing, which is a bit of a gray area. The IRS doesn't have a whole lot of guidance on it. There's not always a lot of clarity on some of these setups. But essentially what it refers to, excuse me, is a disqualified person benefiting from the IRA's investment. So an example of that might be an IRA invests into a private company, and let's say I, Brittany Melville, again, use my IRA. I invest into ABC company. I don't own the company. I don't have majority ownership of the company, so I'm free to invest in it. However, I, Brittany Melville, also provide a service to the company as Brittany Melville. I provide consulting to the organization. And in turn, for my consulting services, I'm paid a salary personally and I have personal compensation. That could be potential conflict of interest, aka self-dealing. So those are the things to kind of think about: is who's involved in the investment, what's the relationship to each other, and is there any way that someone's benefiting as a disqualified person as a result of the IRA investment that's being made. It's important to understand prohibited transaction guidelines, because the consequences of doing a prohibited transaction can be problematic. If it can't be corrected by an attorney, then essentially the IRA ceases to be an IRA and gets distributed to the account holder, the entire amount of that IRA, as of the value January 1st, the year that the prohibited transaction occurred. So it's certainly possible to avoid getting to that point by following the right guidelines, by always checking with an IRA custodian if you're not sure before doing something, and having a good network of knowledgeable resources on these topics. So we talked about prohibited transactions conceptually, so I wanted to provide a couple real-life real estate examples to try to put this in perspective, since I know you're all real estate focused, so this may be helpful when we talk about prohibited transactions. One common misunderstanding that we come across pretty often is someone wants to purchase a property with the IRA, but then they want to use some of their personal funds to cover needed expenses. As I mentioned earlier, if the IRA has 100% ownership of the property, then it has to pay its own expenses. Personal funds can't be used to kind of commingle, to come in after the fact to try to cover for expenses. Additionally, sweat equity is not permitted on any land or property that is owned by an IRA. So for a real estate investor, this typically isn't too big of an issue unless you're someone who has your own development or construction company and then you wanted to work on your own properties. If that's the case, then an IRA wouldn't be a good fit for those types of investments, because you would need to have non-disqualified people doing the sweat equity, the repairs, any of the renovations. So you would ideally be using contractors or property management company so that you can be sort of removed personally from that project. Additionally, when we talk about disqualified people, not only can they not buy property from you, but they also can't live in it or rent it or use it or provide any services to it. So it's important to remember that if you're going to rent out a property, that you are able to certainly do all your due diligence with respect to tenant selection, application screening, lease negotiations, all of that. You can go to the property, you can oversee the property, you can show the property, but you're not able to rent it out to any disqualified persons, and you're not able to do any physical repairs on the property. And then the last one, which comes up all the time, is someone will want to buy a property with a self-directed IRA, but they've already personally put a deposit down on the property. At that point, it's too late, because you've already secured an advantage to purchase that property through a personal contribution or a personal transaction. And that would give the IRA an unfair advantage. So if you wanted to, purchase property with the IRA, it would have to be from the very beginning of the deal, from contract signing to initial deposit, through the entire process. So hopefully that helps to clarify some of the boundaries around how these accounts can be used, and sort of the more favorable scenarios in which to consider using IRAs. So to the fun part, we mentioned in our description of this session that we were going to talk about some of the pending legislation, and there have been changes since we put the description out. So I just wanted to provide an update for anyone first who may not be aware of the initial proposal in the bill that Congress is looking at. And then I'll also provide an update on the changes that were announced a couple weeks ago. So there are a number of different changes that were introduced in the bill. But essentially, I want to talk about just the ones that would impact IRAs. There were a lot of IRA provisions that were introduced. So the first one was that there would be a cap on the amount that can be held in IRAs. Granted, it was a pretty large cap. It was $10 million. But if you may or may not know that there are some billionaires out there that have billions of dollars in Roth IRAs, which are essentially tax-free. So that cap would sort of put a stop to that. That was introduced in the bill, and it remains in the bill, but it has been modified with a couple contingencies, and the effective date was pushed back to 2029. So it may or may not be anything considered in the near term anyway. One of the larger proposed changes that could have had a widespread impact was that they were going to prohibit IRAs from investing in any security, so essentially any investment opportunity that was limited to accredited investors only. So that's where there could be significant implications, because many companies, many private companies, and if you even look at like syndication opportunities, some of them really do just limit to accredited investors. So what they were suggesting is that IRAs could not invest in those if they were required to be accredited or hold any sort of credential or license. As of November 3rd, that provision has been stricken from the bill. The other one that was put on the table was that IRAs would be prohibited from owning more than 10% interest in a private entity. That provision has also been stricken from the bill. That change would have essentially done away with the ability for IRAs to invest and form like their own type of LLC, which is something that can be done. But since it was stricken from the bill, it looks like we're headed in the direction of that not being on the table anymore. And then another one was that this is less related to self-directed IRAs, but a mandatory auto IRA that would have required most businesses to offer a plan or some sort of IRA savings arrangement. And that was also removed from the bill. So it looks like the provisions that would have had a greatest impact on self-directed IRAs are no longer being considered, but of course nothing has been finalized and negotiations are ongoing. So I just wanted to provide an update on that and what that might mean for available choices for not only investors, but anyone with an IRA. And I think it's important to, keep that in mind. So with that, often we get questions about, okay, I understand the concept here now. I understand, how this works and how does this move forward? So if someone wanted to do this, where do they start? What's the first step? And what are the timelines associated? So essentially the first step in setting up a self-directed IRA is always going to be to open an account by filling out an application. And then that can typically be open within a day or two. The second step after the account's been established is getting those funds moved over. And we talked earlier about the different ways that you can fund an account by rolling over from an old plan, transferring from an existing IRA, or making a personal contribution out of pocket. That process timeline can vary anywhere from a few days to a few weeks because there are other institutions involved in moving the funds. And they're typically not very jazzed about letting go of money that they've been holding. But of course, if it's your account, it's your choice to have those funds moved out. It's just a matter of going through whatever processes they require. And there are going to be security protocols that you have to follow, I'm sure. So going through that process is the second step. And then finally, in order to make an investment through a self-directed IRA, you have to work with your custodian and direct them to make that investment. So they're going to need some paperwork, 2 sets usually. So there's going to be a set of paperwork that are made up of internal documents that's going to essentially be your direction of investment to the custodian. So you're going to fill out some paperwork that's going to tell them, I want to purchase ABC property on 123 Main Street for X thousand dollars, and here's the name of the closing agent, and any other contacts that they should know about. And then supporting documentation. So if you're purchasing property, purchase contract. Once the transaction is completed, copy of the recorded deed. The custodian holds that, so there's proof of the asset that the IRA has invested in, and everything should be in the name of the IRA and not anyone's personal name if it's going to be owned by an IRA, so that the IRS doesn't get confused thinking it should be taxed. So the custodian is responsible for collecting all the necessary paperwork and then doing a thorough compliance review on that paperwork to check for those types of accuracies in terms of titling. If there is anything that pops out as this could be a prohibited transaction, the custodian would halt progress and check back with the account owner before processing any sort of transaction. Really, a custodian's main motivation is to protect the tax advantage status of a self-directed IRA, self-directed retirement account. So they're going to do what's in their obligation and what's in their power to keep it tax protected. But of course, as an investor, you still have control over the choices you make, so you still want to be mindful of the limitations yourself as well. But I usually say that all in all, the setup process from end to end, if someone has never done this before, could take 4 to 6 weeks. So it's typically wise to be proactive in getting an account set up. If someone thinks, hey, I definitely want to do this, but I just don't have an investment yet, then you can get the account set up. There's no minimum amount required, so it just depends on what that person needs to fund the investment that they'd like to do. So those funds can just be moved over to satisfy however much they need. And then, of course, when they find an investment, then they're ahead of the game already and the account's already set up, so that they're just submitting the paperwork and going through the review process. So hopefully that helps. Just to tie things back, we talked earlier about the network out there, and there's trillions of dollars in IRAs. Lots in self-directed IRAs now, and more so than ever, and that's growing. But even lots out there that aren't in self-directed IRAs now that potentially could be. There's still lots of networks that are not aware of this option or not fully educated on this option. So as someone who may be looking for investors, it's helpful to have a high-level understanding of this strategy to be able to explain it to others, or at least get them to a point where you can then connect them with a resource to educate them further and help them set it up if they want. But additionally, there's a whole network out there, and you have the opportunity to tap into it. So if you're not doing it for yourself, but if you're doing it for yourself, you certainly have a lot of other opportunities too to further diversify and think about long-term wealth building. And of course, the world we live in, as we said, can be very uncertain, but the more you know, the more options you have to try to spread out some of that risk. So with that, I hope that this was helpful. I hope you learned something today. If you would like to get more information, which I would encourage you to do because we've only just skimmed the surface here, you can visit nextgenerationtrust.com. If you're not trying to talk to someone yet and you just want to collect information, you can kind of self-serve your way through the website. You can download a lot of information to read. There are also lots of on-demand webinars that we present with different investment sponsors, so it can help you kind of get some ideas of some of the neat things that you can do. And then in addition, there are lots of ways to get in touch. You can email new accounts, you can call the office. We always have a live person answer the phone. And then there's also a text option through the website. So we're happy to help guide you through your journey to get educated. And I think we can, Anthony, I see you're back. Maybe we can take questions if we have any.
Yes, we do. Great presentation, Brittany. Like always, Brittany has been giving lectures now for the whole year of 2020, and she's been fantastic and really, really a good company to work with. We have a first question here. Can you use your self-directed IRA funds to educate yourself on making good investments?
That's a good question. That's probably more of a tax advisor question, as to whether you could potentially, like if there's an exception to withdraw funds for the benefit of making good investments, and you could put them toward like courses or educational costs, I think is the question, what the question is asking. I'm honestly not sure of the answer to that. I could say that here, we don't process anything like that for our clients. They're mostly directing their funds right into a specific asset. But I would ask your CPA or tax advisor if there is some sort of exemption that would allow you to use those funds. It's a great question.
And Brittany, what he was saying is what Mike was saying. I was thinking more about prohibited transactions.
In terms of using the funds to educate yourself, I guess that's where I'm getting a little bit, I'm not very clear on exactly what the question is asking.
And then again, Mike sent back, would education be prohibited?
Well, you can certainly educate yourself as much as you like. I would also say, I would also revert back to my initial recommendation that talk to a tax advisor about whether you can use funds out of an IRA to educate yourself. But I would also say that you probably don't need to, because there's so much free information and good information available to you to educate yourself. The only thing that I would say is that if really complex investment scenarios come up, there may be cases where it's beneficial to have an ERISA attorney get involved to provide legal guidance. I don't know that I would classify it as education so much, but there may be situations where getting some legal advice on a particular investment through an IRA would be worth the investment. And in that case, the IRA can pay attorney fees for that. So hopefully that helps a little bit.
I was going to, now that you brought up the attorney, does your firm itself, Next Generation, if say me, the investor, wants to go out there and use my IRA, does your firm also help with legal advice on behalf of Next Generation? Do you have the legal advice, or do we have to get our separate attorney that is, knowledgeable in IRAs, of course?
So we don't have attorneys on staff here, but we do have a network of attorneys that we know of that we work with regarding mutual clients. So there are a handful of them even on our website that we have listed with their contact information. They're not employed by Next Generation, and we're not endorsing them in any way, but our clients have certainly used them, and they have expertise specifically in working with self-directed IRA type matters, which is typically what we highly encourage if someone's trying to do something and they need an attorney.
And, another question is that can you use part of your IRA as a down payment and get the rest of the money from the bank? Or do you have to use the entire IRA to purchase the property?
That's a great question. We get that question a lot. If the IRA, so technically the short answer is no, the IRA is not permitted to just provide a down payment and then let me back up actually. If the IRA wants to purchase the property and get the loan, then the IRA can provide the down payment, and then the IRA can take the loan to leverage the property. However, a lot of times we get the question, can my IRA put down the down payment and then I personally buy the property? And that's not permitted. So if the IRA is contributing something to the investment, then it needs to take a percentage of ownership. So that's a situation where it would work to partner with the IRA, but not to just give the IRA ability to make a down payment and then handle the rest personally. That makes sense.
I guess another part of that question is this investor wants to move to the south. There's a lot of building, of course, a lot of movement down there. He wants to know if he could put down a down payment using his IRA. Okay. And also not only he's thinking about flipping as well. They
Mhm.
buy and then they flip during the period. Are you able to play that role? Can the IRA be used for a down payment? And then of course, within the 30 or 40 or 50 or 60 day, this I guess is during the pre-construction period. Could it be used for flipping as well? And not ownership or investment purposes, a fast flip.
Yeah, the IRA can certainly do that. But if there's going to be any sort of ownership at all, and the IRA is putting money in, it still would have to take ownership while it's being flipped.
Exactly. All the
Yeah,
monies have to be used. All the monies have to be used during that period. Okay.
correct. Yes.
Are the products that you offer pure IRAs with options to sell them at any time versus some apartment complexes that are not liquid?
So I guess what I'm taking from that question is, do self-directed IRAs have the ability to purchase more liquid assets?
I think that's what I'm reading into this as well. I was
Yeah.
trying to figure it out. I know Ron left.
I think it depends on the asset itself. But it would still have to be a non-publicly traded asset. So self-directed IRAs are more geared toward private alternative assets, which by their nature tend to be more illiquid. So that question does come up pretty often when we start talking about required minimum distributions. If someone reaches the age of 72, let's say they have an IRA and they own property and they have to take an RMD, how does that work, right? Where they can't just easily liquidate it. It's not like a stock where you can just press a button and sell it, within hours or whatever. But there are, depending on the type of asset that's held, like for example, you can hold cryptocurrency in an IRA. So that would be something that you could more easily liquidate than if you owned property directly and you'd have to sell it and go through the whole process. So I would say that ranges, and that's something to keep in mind.
Well, thank you, Brittany. You had a lot of people that said, great presentation, very informative, and they're all thanking you, Brittany. So once again, thanks again. Brittany should have, she'll have by tomorrow all of the names of all the people that did register for her event live and also streaming. And she will be sending out a thank you note to all when she does get her video, of course, in a couple of days. And you can continue asking Brittany questions, and she'll be available. I did put her name and her email address and her phone number in the chat section, but of course, she'll be sending out a note to all of you with that contact information as well. Once again, Brittany, thank you so much. This concludes our webinar, and I want to wish everybody and thank everybody for coming on and registering for Brittany.
Thank you, Anthony, and thanks everybody for your time today. Enjoy the rest of the conference.
Thank you, Brittany. And thanks, everybody. Bye-bye, everybody.